Yeah, so typically ESG investments is a much more recent phenomenon in Asia. Over in Western markets, particularly in Europe, this is something that has gained traction over the last 2 decades or so. So over the last 2 decades in Europe, you can see that investors as well as the companies issuers have gained a lot of knowledge in terms of defining what ESG investments is about, the risks and opportunities, as well as the frameworks needed to actually analyze these risks and opportunities. So there is definitely, a lot of knowledge in Europe that Asia is still catching up on. So over in Asia, there is increased awareness, but the level of sophistication and advancement in terms of handling ESG related data as well as performing ESG analysis, this is still in its infancy. But I don't think that we are going to take 2 decades to reach where Europe has achieved in the last 20 years. This is a very steep learning curve, and with the knowledge provided by the ones who have already had a head start, we'll be able to shorten this learning journey by at least a decade to achieve the sort of ESG investment parity, so to speak. So over at Eastspring, there is this recognition of this gap in knowledge, both amongst the investors as well as amongst the issuers, who are still grappling with this ESG knowledge gap. So what we try to do is to create a framework to analyze ESG risks and opportunities, and then we apply it in some of our ESG focused strategies, such as the Sustainable Bond Fund strategy. Okay, so green social sustainability bonds, these are also known as GSS bonds. These are debt instruments, and the use of proceeds are channeled to fund projects with actually positive environmental as well as social impacts. So, for example, a green bond can be issued to actually fund the construction of a green building, or it can be used by a developer to refurbish a building to actually make it more energy efficient. A social bond will be one where it's used to actually fund the construction of affordable housing for the less fortunate. But I just want to highlight GSS bonds, they only form 1 to 2% of the total market capitalization of the investment universe. So there are a lot of other bonds which ESG investors can actually invest in. And this is precisely why we actually came up with a framework to actually expand the opportunity set. GSS bonds were intended to actually make ESG investing actually accessible to investors by making it easy to understand. But we would like to take this further by actually analyzing the conventional bond universe and picking the ones with good ESG qualities and then incorporating into our portfolios, like what we do in the Asia Sustainable Fund. So interest rates are very much driven by the Fed, and since the start of the year, the Fed has hiked aggressively from close to 0% to now above 3%. By the end of the year, it's projected that we will end up above 4%. So with this significant tightening, there is a lot of uncertainty that has been injected to the markets. Investors are uncertain about the impact of higher interest rates, what it means for their investments. And resultingly, you actually see significantly higher volatility in the market. So in this market context, I think it advocates a certain level of caution as well as being sufficiently nimble to navigate all this uncertainty as well as volatility. In this environment, I think there are two major risks which fixed income investors should be aware of. Number one is the risk that interest rates might continue to rise higher as the Fed continues to tighten further. The second, of course, is as you have tightening financial conditions, the risk of recession actually increases significantly. So in the context of these two risks, I think Asian fixed income investors, should actually adopt a more cautious as well as tactical approach in their investments. Number one, they could actually take less duration risk, meaning they concentrate their investments in bonds with shorter tenors, because this would limit any drawdown that would actually arise from higher interest rates. So in navigating the second risk, which is the heightened risk of recession, Asian fixed income investors can actually focus more on higher quality credits. These are investment credits which are more likely to actually weather through the uncertain economic conditions in the next 12 to 18 months, as compared to those with a lower credit rating, which might face increased headwinds, especially if financial conditions do tighten and the access to liquidity actually diminishes over the next 12 to 18 months.